We have with us Mr. Ramesh Iyer, the MD and Vice Chairman, joining us to talk to us about the earnings. Well, we saw 50% growth in disbursements in the quarter gone by, but going ahead, there's going to be erratic monsoon in the country. People are talking about El Nino, etc., as well as the FMCG are talking about some stress when it comes to the rural economy. What's your take with respect to how the disbursement growth is likely to be?
If you look at last about close to about 8-9 quarters, we've been repeatedly saying that the rural sentiment is positive as far as we concerned. And the reason I'm saying that is most of the vehicles or tractors that we finance are all put to use and they earn out of them. It's like a lively product for them. And therefore, what we have seen is a need-based product in rural is doing extremely well, and we continue to see that. We are continuing to see demand for pre-owned vehicle, which again is a reflection of that the need for vehicles to be put on road for their earnings, because the tourism is doing well, people movement is good, infra is doing well, and therefore we don't see any pressure out there. In as far as you refer to the monsoon part, I think the overall report does say that the monsoon is expected to be around average. What one has to wait and see is how widespread they are and how they are relevant to some of the states where it is important. And we do believe that that should do well. And the water levels are pretty good. Even in the yield that we just saw, and I think all of us have seen, even the wheat purchases have been pretty good. So we are very comfortable to believe that the rural sentiments will hold up, and the next 2 or 3 years would see a growth for at least the segment that we are representing.
Now, overall sentiment looks good, but can you highlight the pockets that are doing well and those where you're feeling a pinch? What's the outlook, Mr. Iyer, in terms of which loan segments could really drive the growth going forward?
I think clearly we have seen growth across the country without exception in every state and almost every product, which is why, cumulatively we said that the sentiments are very, very positive. We have not seen any pressure in any segment, at least at this stage, and we continue to believe that they would not do well. I think I would like to remind that we are playing in the largely earn and pay segment, and that's a reason a couple of years back we had pressure when this segment was not doing well. Currently, we see almost all vehicles, tractors, everything is fully deployed, in fact, to their full capacity, and we don't see any pressure on that front, and we continue to believe we would do well. In as far as the personal segments are concerned, we have entered the affluent customer segment, and we are offering very competitive rates out there to be able to compete, and that's helped us even gain market share. So you should overall understand that the segment that we were largely present in is doing pretty well. The new segment that we have entered into, we are actually gaining market share. And then thirdly, we have added new product lines like SME, LAP, etc. The three things together is what really driving the growth, and we don't see any concern around that.
Okay, another standout in your earnings this quarter was the asset quality, which has also improved quite meaningfully, and also provisions have fallen sharply. What are the factors which are driving this improvement, and what about the road ahead?
Not necessarily. I mean, see, these are not arising out of new loans that have been lent, right? This is the decreasing trend of NPA is largely out of the existing book that we have, which means these have all been lent already a year, 2 years back. Clearly, please understand, and this has been repeated by several times, the earn and pay segment, when they don't earn, there is always a pressure, and therefore you will build up habit. Now that we are seeing good earnings for these customers, these are all very genuine customers who were hit circumstantially a couple of years back, and therefore the delay. Currently, they are all earning well, and therefore you can see their intentions to repay very, very clearly. I think it's also important to understand that various support has been provided to our own teams on the ground. Wherever there are customers who are earning but are not paying, we call them as the intentional defaulters. I think we are reaching out for a settlement with these customers. We are using legal tools, and therefore you will see an overall improvement. But fundamentally, it is an outcome of the positive earning sentiments in the rural market. And my last comment would be, whenever the business does well, the collection is bound to do well because it's an overall reflection of the improving cash flow. Because when somebody buys a vehicle, they do bring in 25% margin money, which means they are able to bring in 2-3 lakh of rupees upfront. That is nothing but a clear outcome and the visibility of the improving cash flow in the rural market.
So what is the asset quality target that you have in mind?
So if you look at our book, if you look at our new book, they are trending at a very, very low NPA levels of sub 2%. And as far as the current book is concerned, that is the past lending book is concerned, that's come down to a 4.5%. And the net is just 1.9%. So therefore, we would resort to aggressive settlements with customer. Wherever there is requirement to take back the assets, will be more than willing to take back the asset and transact all them. So I think one has to look at the book from two angles. The existing book of 4.5 definitely will show declining trend through settlement mode. And as far as the new book is concerned, they are sub 2%. So the overall NPA levels as we see going forward would be much lower than where we are if you take the average of the two added.
Sure, that point is taken, Mr. Iyer. But in a rising interest rate scenario, what's the quantum of rise in cost of funds you're expecting in FY24, considering the liability mix that you have?
So, fortunately, we run a very good ALM. And therefore, even in the last one, when we saw 200 basis point increase, for us, the impact was only about 60, 70 basis point, which was mostly passed on to customer. Even going forward, I think we would see an impact of maybe a 25, 30 basis point that could come in because of the liability mix changing. But we also believe that in the next 2 quarters from now, one could see a declining borrowing cost. And that if happens, this 25 odd basis point would get offset. The other two factors which actually have helped us, that we got upgraded to AAA recently, and that has helped us 20 basis point in some of the instruments that we borrow, which brings in a overall benefit of maybe about 10 basis point for us. And the last point would be many of our assets qualify for PSL, and we do offer them to someone who requires a PSL asset, and that gives us another rate benefit. So put this all together, we have been able to offset the increase to a larger extent given our ALM mix as well as the mix of product that we have. And I think we don't see a pressure on margin on account of borrowing cost. And if there was so, maybe a 25, 30 basis point over a period would get passed on in the next year.
Right, and given that your Opex has shot up as you're investing in technology and processes, when do you expect your Opex to normalize, and when will the leverage of these investments actually start playing out?
So, technology investments, etc., or even investment in people, training, etc., are a long-term benefit that we are looking for. And we expect that our current Opex may come down to a 2.75 in the next 3 to 4 quarters or maybe a little more. We are consciously invested in that. And the returns are factoring that this would be the cost of operation for at least another 3, 4 quarters. So we're not in a hurry to push that, but clearly there is a view on certain expenses which are not required to be incurred once that we have invested in technology, which should be definitely looked at. But will we see a cost of Opex come down very, very fast? I think it's a sensible and a well thought through investment, and we would not expect them to come down very, very fast. But in the next 3 to 4 quarters, you will see benefit of all of this.
Okay, Mr. Iyer, on that note, we'll let you go. The stock is spiking 5% as we speak. The commentary regarding the way forward is also quite impressive, and that's the reason we're seeing the reaction on that counter. So the stock holding up 5% higher as far as Mahindra Financial is concerned. Overall,